Hello. Welcome everyone that's here. How are you all? My name's Misty. We're here in Houston, Texas. So why don't you do a few things for me? If you came to our, webinar broadcast page, right below this video, you'll see a button that says watch on YouTube. And you can stay here, but if you want to comment and ask us questions that we can answer at the end, you're going to want to check that box or click the box and go watch us live on YouTube. So we'll give you a minute to do that. We want you to ask questions. We want you to chat. And so right now, why don't you drop in the comments if you're live on YouTube where you're watching from or how you know myself or Tonya. So can y'all go do that? I want to see. I'm going to go make sure all the back end stuff is working. And I'm on the wrong website, so just give me a second on that. We're going to bring Tonya on. Let me turn that volume off. Okay, good. So I see Dondi is live on YouTube. Woohoo! Everyone, go post where you're watching from or how you know Tonya or I. Okay, that's what I'm asking for. Pretty please. That way we have questions at the end. All right, so I'm going to bring on Tonya, and we're just going to wave real quick. She's not on her just yet. And then we're going to open up our big, beautiful tax changes bill, or the bill and the changes and what it means for you. And we're going to do a little intro real quick, okay? So hopefully y'all will keep watching on YouTube. I see Sarah, a friend from Washington, and I see Neil Woods, yay, from Dripping Springs. All right, guys, well, let's get to it, okay? So before we dive into all the good stuff, which Tonya is going to be doing that for us, we're going to go over a little bit about who we are and why you can trust us. So Misty Newsom CPA LLC, if you couldn't tell, is founded by me. My name is Misty Newsom. I've been a licensed CPA in the state of Texas for 21 years now. In 2004 is when I got my license. I adore helping business owners understand their finances, going from confusion to clarity, and making sure that you can run your business and lead well. We have a wide range of people that work for us. There are 10 or 11 on our staff. We have 2 CPAs, AFSP, we have CAS analysts, we have bookkeepers, we have all kinds of things. So we're very well qualified to give you all the details about this tax bill. At the end of the day, I'm sure you've heard some things, right? You've heard some things on the TikTok, which I'm not on, but I see it, on Instagram, on Facebook. Even in the past week since this bill was passed, Tonya and I have been messaging back and forth. Hey, did you read this? No, that's not what I read. And so we've dug into the 940-page bill to make sure that everything that we're telling you is truth from the bill, not from someone else. So a little background on me. I'm a nerd. Part of my testimony is I have wanted to be a CPA since I was 10 years old. My uncle was a banker. He was also a CPA. I liked his hours. I liked his vacation and his days off on Mondays a lot. And so I pursued that at Baylor University. I started doing taxes and payroll back in 1999 at the CPA firm I worked at in Waco. And I've loved it ever since. I have always helped people on the side. And then in 2021, I started this firm to really grow my business, to work from home. We have 6 kids. Those are the people in the little picture right there. And be able to continue homeschooling them. It's grown. We're a cloud-based remote firm. That's why we do these things like streaming and having fun, and we get to help entrepreneurs do the same thing. I love building relationships, and so I've done most of the things you've done, and we can answer the questions that you have. So without further ado, let me introduce Tonya. She is going to be the one presenting tonight. A lot of our team is in the background. 2 of them are right here because we're at our management retreat right now. She has been doing taxes for 21 years as well since coming out of the Army. She has worked in so many different industries. She knows transportation, she knows real estate, construction, service-based. She's been an administrative assistant, and she's currently studying to get her EA. She'll hopefully pass 2 parts this year and 1 part next year. She'll tell you she loves taxes, gardening, and her family. Those are her things. So without further ado, I'm going to step back and I'm going to let her get going with this tax bill and what it means for you.
Hello, everyone. Now, yes, as Misty said, this bill is ginormous, and with 940 pages of law, there is a lot of information that I will be throwing out tonight. So as you have questions, please drop them in the comments, and we did hopefully save enough time at the end to answer them all live. So go ahead and start with a little bit on the front side of what this big, beautiful bill is. That's the nickname. So its formal name is the Tax Relief for American Families and Workers Act of 2025. It's a comprehensive tax reform package that makes key provisions of the Tax Cut and Jobs Act permanent. It simplifies the tax code slightly. It expands middle class relief and reverses a lot of those green energy deals from the Inflation Reduction Act. It was introduced in May as a budget reconciliation act. What that means is that if it didn't have a one-to-one direct spending result of things that were already there in a true budget act, then it couldn't happen. So we'll go through kind of how that looks later. It was passed in the House on May 22nd by a very one-to-one vote. And it was passed in the Senate on July 1st with amendments, which means it had to go back to the House. And it did. And it was passed on July 3rd. And then it was signed into law by the president on July 4th. All right, so we're going to talk a little bit about some of the online speculation versus reality in the bill. So some of the online things that we heard is that we're going to make the Tax Cut and Jobs Act permanent. There's not going to be any tax on tips and overtime. There's not going to be any tax on Social Security income. There's going to be an auto loan interest deduction. There's going to be a SALT cap increase, and there's going to be some earned income tax credit certification. All of those were floating around online. Now, on the flip side of that, what really happened in the bill? It did make some parts of the Tax Cut and Jobs Act permanent. The no tax on tips is temporary, along with no tax on overtime. Not only is it temporary, it's also income-based, and there is a cap on it. And then there is a temporary additional senior deduction. So we didn't end up with no tax on Social Security income. There is an auto loan interest deduction. It is capped, it is income limited, and it is only for new cars, and we'll go through what that looks like. And then there is a SALT cap increase, but again, it's temporary, income limited as well. And there was absolutely no change to the earned income tax credit. All right, here are the things that happened that we've been used to, and they're either going to stay the same or there have been some slight changes to them going forward. All right, so our individual income tax brackets, they stayed the same. The brackets are going to be indexed, and what that means is those income will change throughout the years, but we still get these brackets, the 10, 12, 22, 24, 32, 35, and 37%. Our standard deduction is now the only deduction we get, and it is indexed, and we did get a slightly bigger bump than we were expecting, but it will be $15,750 for single and $23,625 for married filing jointly. The other dependent tax credit is here to stay, along with the estate and gift tax exemption of $15 million. The student loan forgiveness, if it is due to death or disability, it is not taxable. So things that are slightly changing. Everything else in the bill that stayed around is slightly changing. So our child tax credit is now indexed. That's a good thing. Our child tax credit hasn't been indexed in a very long time. It is now, which means it will move with inflation. So it's $2,200 per child starting in 2025. Now our senior deduction, we've had a senior deduction. What this bill does is it increases it for a short amount of time until 2028. And what we currently get is a $2,000 deduction. It's what it was. What the temporary increase is up to $6,000 if you make under $75,000 single or $150,000 married filing jointly. This is for anybody over age 65 or qualifies for the blind section of, or if you're temporarily, not permanently blind. There's a phase out for over, if you make over $125,000 or $200,000 married filing jointly. So make sure that we're looking at those numbers when you're doing your planning. All right, how will this directly affect you? So scenario 1 is what it was before the bill. Scenario 2 is now that the bill is passed, what will it look like? And scenario 3 is slightly more income and how it adjusts. So Mary is a 67-year-old, recently widowed, now, so she now files single, who has income through retirement accounts, investments, and Social Security, of which $30,000 of her Social Security is taxable income. So before the bill, her AGI was $74,000. Her standard deduction would be $15,000. Her additional deduction is $2,000. Taxable income, $57,000, making her effective tax rate 10.6%. Now, after the bill, at $74,000, she gets that standard deduction bump of $15,750 and that additional deduction of $6,000, leaving her taxable income of $52,225. So her effective tax rate goes down to 9.19. Now, if she makes slightly more income of $90,000, let's see how that changes. That means her standard deduction stays the same, but her additional deduction drops to $5,100. So that leaves her taxable income of $69,150 and her effective tax rate of 11.69%. So, all right. Now we also get our AMT, higher deduction limits, but it does have a larger clawback. So when you start getting up into the 37% tax bracket, and those higher limits, instead of a 25% clawback, it's going up to 50% clawback. So make sure that you're looking for that in your planning. Mortgage interest deduction, we do have a limit of $750 permanently, but it also does add mortgage interest premiums as our interest deduction. So our PMI, we get to write off as interest deduction now. Casualty loss deduction has, for the last few years, it's only been federally declared, but now they added state declared disasters as well. Our itemized deduction limitations, our P's deductions are back, but slightly changed. So it is only a reduction for our top tax bracket, that 37% tax bracket. And it is a 2% across the board reduction for itemized deductions. Our qualified business income deduction is going to stick around, but our income thresholds have been increased to $75,000 and $150,000, and we do get a minimum deduction of $400,000 or $400 if you make $1,000 in income, and both of those will be indexed moving forward. So what this appears to be in the bill is that unless you are making $1,000 in self-employed income, you will not be getting a QBI deduction going forward. We're still going to have to see kind of how that plays out as far as what the Treasury comes out with. Some additional things. Moving expenses deduction. We've lost it except for the military, but we did add the intelligence community to the moving expenses deduction. ABLE accounts. These are pretty cool accounts, and they got some nice increases this year. They're indexed contribution limits now, so those limits will move up with over time, which is nice. It does qualify now for the Savers credit as well, and we can do rollovers from our 529 or our qualified tuition program accounts. Our Savers credit got a bump for the first time in a long, long time. So it is now $2,100. Now our SALT deduction cap, we did move from $10,000 to $40,000 only until tax year 2029. And that is indexed from 2025 to 2029. And then it will be back down to $10,000 in 2030. And that is income limited to below $500,000. And then we have a large section of Africa added to the Armed Forces Hazardous Duty area. All right, how does this affect you? So again, the same setup for our scenarios. John and Mary file jointly and live in Texas with a decent sized house for which they have a mortgage. They itemize and make decent money. They also give often to charity. So scenario one, before the bill. Our AGI is $320,000. We itemize for $44,000. We get taxable income of $275,000. Our effective tax rate is 21.3%. Scenario two. Our AGI is $320. Our itemized deduction is $56,000 because we get to take all of our income tax or all of our property tax. And so that leaves our taxable income of $264,000, and our effective tax rate is 20.09%. And so scenario three, we're making slightly more money. Now remember that we're that $500,000 bill. So we're at AGI. So we're at our $500,000 limit for our SALT cap. And because we're married filing jointly at $550,000, we also fall into our highest tax bracket of 37%, which means we also get a reduced itemized deduction for our PEAS clawback. So that brings our itemized deduction down to $43,120 and our taxable income of $506,880, leaving our effective tax rate of $22,004. All right, some renewals and adjustments. These are things that came back and things we're adjusting going forward. All right, so bonus depreciation is back and it is permanent, back to 100%. And as long as it was put into service after January 19th of 2025. So there's 18 days that we don't get to use that stuff for bonus depreciation. So make sure that you're looking at that. Research and experimental expensing. So if you are investing in research and development, if it's domestic, you get to fully expense it out. If it's foreign, it's got to be amortized. And small businesses may be able to recapture back to 2022 all in 2025 without having to amend, but also, you've got to fill out that 3115. Business interest limitations are permanent, and we are back to the EBITDA calculation. What that means is as a business, you are limited to the amount of interest that you can take based upon your income. Well, the income has been calculated different ways throughout the years. Now it is calculated pretty much to the most extreme. Excuse me. So you'll be able to get more interest deduction because we're taking it income before your taxes and your amortization and depreciation. Our paid Family and Medical Leave Act credits are back. These are employer credits. They're based on the wages paid during FMLA, and it also includes insurance payments. Our Section 179 expensing has been bumped up, so it's a higher limit to $2.5 million in expensing now a year. And our employer provided child care credit. Now, if you're an employer and you provide daycare services to your employees, you now get to deduct up to 40 or 50%, depending on the size of the business, of those costs. And the upper limit for that is $500,000 or $600,000 credit, and that will also be indexed going forward. For our adoption credit, it is now refundable and indexed up to $5,000. Now, indexed means that that number will move every year. Now, it also recognizes the Indian tribal governments for special needs designations. It used to only recognize state special needs designations. Our dependent care assistance. So these are your cafeteria plans. You get to put away up to $7,500 now instead of the $6,500. Your dependent care credit moved up from 35% to 50% of expenses paid. And the phase down is a very much larger range. It was from $15,000 to $45,000. It now goes from $15,000 to $75,000 before you're stuck at the 20% range. Employer payments of student loans. This is now a permanent credit, and it's $5,250, and it will be indexed. Our 529 accounts have been expanded in many, many ways. So our limit for primary, our elementary, high school, middle school expenses has now been increased to $20,000, and it is expanded to include tutoring, curriculum, supplies, a whole bunch of that kind of stuff. And it also now includes post-secondary credentialing, both testing and study aids. So our CPA exams, our project management, our welding exams, any kind of those state exams that are listed on any of those specific credentialing sites. Opportunity zones. Opportunity zones are now permanent, and they are now made on a 10-year rolling designation. So it will take 10 years to adjust your opportunity zones. And there's some new reporting requirements. So definitely, if this is something that you're interested in or you have a business in, you need to get with your tax preparer about what is now required for this credit. There's also a new markets tax credit, and that is now permanent. And this has to do with some more research and development stuff. Qualified small business stock gain exclusion. This one's always kind of cool. It's permanent now. You must hold it for a full 5 years to get the full exclusion. But what they gave us now was that exclusion starts at 3 years now. You get to exclude a percentage, and at 3, 4, and 5 years till full. Now, the thresholds have changed for our 1099s. I'm sure there's lots of small business owners that are happy about this. So our 1099 thresholds are back to $20,000 starting this year. And starting next year, our 1099 NEC thresholds have changed to $2,000. And those will be indexed through the years. Now, our Section 181 starts this year. And this is a cool section that a lot of people don't know about. But because it was so limited to the theatrics, it was limited to theater. But now it also includes TV and film production. So this is an expense deduction similar to our Section 179. It's just Section 181. And this is specific to kind of those production equipment stuff, sound and video equipment. We also have an excess business loss limitation, and that is permanent. So our NOLs moving forwards. Education credits. These are some of those slight changes. Requires a social security number now, and our AOTC, our American Opportunity Tax Credit, requires the EIN number of the school in order to take that deduction. Our Advanced Premium Tax Credit. It's still around, it's there, but if you over-receive it, you will owe all of it back no matter what the income level. This is very important. It used to be income limited to what that payback of that was. They've taken that out. So make sure that you're making the right amount and they're calculating the right amount when you're getting that advanced premium tax credit. HSA plans now include all bronze and catastrophic plans. This is huge for many people on the marketplace. So as this adjusts over the next little bit, you may now be eligible to open up a health savings account plan. What is new? All right, this is the fun stuff. No tax on tips. So this only applies for tax years 2025 through 2028. What it does is it excludes your tip income from the federal income tax. That is what we call an above the line deduction. What that means is just like your student loan interest, you get to deduct it, above the standard deduction when you take it on your taxes. The cap on this is $25,000, and the phase out begins at $150,000 single and $300,000 married filing jointly. It gets fully phased out at $275 and $425. The definition of tips is it has to be on an occupation listed on the federal tip list that will be coming out soon. The requirements are you have to have a social security number, and if you're married filing singly, you don't get to take this deduction. Employers have to continue reporting your tip income on your W-2 and your 1099s. It has to be reported tip income in order to take the deduction. Your maximum impact of this, if everything is perfect, you'll get to reduce your overall taxes by $6,000. In reality, we're probably looking at somewhere between a $0 reduction and $3,000 for most people. On the business side of things, you should also be able to exclude your tips for independent contractors. And the cravat with that is that it will also be excluded from your QBI deduction. So this could adjust your QBI deduction as well. Beauticians are now included in all tip laws. That includes the federal minimum wage of $213 an hour, and it also includes the employer FICA tip credit. The secretary is supposed to be releasing a list of covered occupations, but we know for certain that if you're in the food and beverage service industry or you're a beautician, because those two industries are codified in the law already, we know those two industries do qualify. We'll find out what the other ones are soon, hopefully. Just to make sure that we know that while we get to exclude these from our federal income tax, you are still charged Social Security and Medicare on these wages. That is why they have to be reported. And they also may impact your eligibility for things like EITC, some of your additional child tax credit, those types of things. All right, no tax on overtime. When 2025 to 2028, you'll see a pattern here. It excludes overtime compensation from federal income tax, just like tips. This is above the line. This is just reducing your federal income tax itself, your federal income. The cap for this is $12,500 per individual or $25,000 for married filing jointly. The income phase out at this starts at $150,000 for single and $300,000 for married filing jointly. It's fully phased out, not too much higher than that. $275 and $425. It has to be legally paid overtime with the definition either over 40 hours or over 8 hours daily, and it does include the tips. Your requirements: Social Security, married filing jointly, married filing singly, you're unable to take. And employers have to report this separately as well on your W-2s and 1099s. So our maximum income act at this is $3,000 or $6,000 reduction of tax. That's if everything is perfect. And so looking at really how this really will affect you is somewhere between $100 and $6,000, depending on what your income level is and how much overtime you've truly worked. No tax on new car interest. So again, tax years 2025 through 2028, and this excludes interest paid on personal use vehicle loans. Again, very similar to student loan interest. This is going to be deducted the same way as overtime and tips as well. This is above the line. Our cap on this is $10,000, and our income limitation phase out starts at $100,000 or $200,000. Now, the eligibility for this, it has to be a first lien loan. The vehicle has to be new. It has to be assembled in the U.S. It has to be under 14,000 pounds, and it cannot be used in a fleet, commercial setting, or be a salvage vehicle. The requirements are you have to report your VIN number on your tax return. And lenders will be issuing something similar to the 1098 INT we see for mortgage interest now. The maximum impact of this is going to be a $2,200 reduction of your taxes. All right, Trump accounts. Before I get too far into this, I want you to let you know that the information for this is evolving, and this is based upon what is written in the law. And so there will be a ton of information released about this over the next year. This is a pilot that will be starting in 2026 through 2028 for children born in 2025 through 2028. It creates a tax-advantaged retirement-like account for children. The requirements are the child must be under 18, and both the children and parents have to have a Social Security number. Contribution details. Again, we don't know too much about this, just what is written in the law. There'll be some guidance coming out. One-time $1,000 federal contribution per eligible child through the pilot program. And then there will be an annual contribution limit of $5,000 per child, indexed for inflation after 2027. And the employer contributions will be allowed up to $2,500 per year, which will also be excluded from employee income and will also be indexed for inflation. Withdrawals. They will not be allowed any withdrawals from this account until the beneficiary or the child themselves turns 18 in the calendar year. And then it will be determined on kind of how that works and what the taxable situation of these are. How to establish one of these accounts? Well, that's a really good question that we do not have real clear answers for right now. What's provided in the bill is that there's a provision for the secretary to create them or for them to be created in the U.S. for a minor funded by a qualified rollover. And it also requires a 12-month wait after the date of the enactment of this law. So there's going to be a lot of guidance that comes out about who can open one of these accounts, how they can open them, and kind of where this goes. The bill does limit how the funds are invested. They can only be invested in US-based index funds based upon market capitalization. And since they added this to the retirement section of tax law, I suspect, and the expectation is that it will be treated pretty similarly to Roth IRAs. But like I said, there's going to be a lot of guidance coming out over the next 12 months about these. All right, here's some other random new stuff that we get. Charitable contributions. Remember in COVID, when we got to take that above that charitable contribution, well, it's back, and we get to take $1,000 or $2,000 for 9 people who don't itemize. If you do itemize, though, we have a floor now. You have to exceed 0.5% of your income in order to take any charitable contributions. And for corporations, we have a 1% floor and a 10% ceiling that you get to take for charitable contributions. And none of this is rollover amounts either. We do get a credit for contributions to scholarship granting organizations. Now, this is a tax credit, and it is set up for private granting organizations. They can't be affiliated with the school, but this is kind of a good way to give back in a different way, and you cannot take the state and federal level for that. But this might be something that you want to look into, because you do get a 1-for-1 tax credit for up to $1,700. Now, there is this new section 1062. They shifted these sections around, and what this does is it gives farmers who sold their farmland to a new farmer the election to pay their capital gain tax in installments. So this is pretty cool, especially if you know farmers or work with farmers or that are looking to retire and get out of the farming business. So this may be a good tax planning situation for them. All right, qualified production property. These are our manufacturing properties, and they get 100% bonus depreciation, but it has to be put in service by the beginning of 2031. And state income tax. There's now a new economic nexus that will not be required to file income tax if the only nexus that you have is economic versus physical. So we'll be getting a lot more guidance around how that works too. They're trying to close some of the state loopholes with that as well. What are we losing? Wrapping up. All right, our credits that are leaving by December 31st. We're losing our energy efficient home improvement credits. These are our new windows, new doors, insulation in our houses. If you're going to get it done and you want to take the credit, it needs to be done by the end of the year. Our residential clean energy credit and our previously clean vehicle credits, they're all gone too by the end of the year, along with our clean vehicle credit on the individual side. On the business side, we're losing the work opportunity tax credit. That is the employment tax credit that you get for payroll taxes for hiring somebody who has been designated as harder to employ. That will be gone by the end of the year. And the commercial clean vehicle credit will be gone by the end of September. All right, credits that we're losing by the middle of next year. Really, that's that alternative fuel refueling property credit. That's that electric plug-in credit that we got. And we're also losing on the business side our energy efficient commercial buildings deduction and our new energy efficient home credit. Now, while this is a business credit, this typically gets pushed through from our builders to new home construction buyers. So our new energy efficient home credit is one of those rebates that the builders will give to new home buyers. So if you are looking at buying or building in the next year a new home and want to take advantage of some of those rebates, I suggest that you start talking to somebody before and have that contract in place before the end of June next year. And then we're losing some of our clean electricity credits, leaving later. Solar and wind are both gone at the end of 2027, and then our hydro plants and nuclear facilities after 2032. All right, time for questions. See, we have some.
Can you hear me, Tonya?
I can now, yes, Misty.
Okay. Sarah, your friend, has a question. She said, so wait, does the $6,000 replace the 65 plus or blind deduction, for the new Social Security additional deduction?
It does. So the 6,000 is now the new senior 65 plus blind deduction. It is the $6,000 deduction, but
so it's not 6 plus 2. It's just
correct. It is not 6 plus 2. It is just now 6.
Okay.
And it is income limited.
Yes. And then another friend of mine, Neil, said, as seniors, these changes, especially the new SALT cap, for all of us that live in Texas and that have ridiculously high property taxes, it's super helpful for us. And it will drop our overall tax rate a lot. So his question is, will the IRS take that into consideration, or will our 2025 return make us more susceptible to audit?
No, so it won't take all of those as long as it follows in line with everything. It's not going to make you more susceptible to audit if you now itemize versus when you didn't previously.
Oh. Awesome.
Do we have any other questions?
Yeah, there are still some of y'all live. Hopefully you got some new information. But yeah, those questions were all coming through, so that's exciting. Last time we had none. I don't think anyone knew how to comment though last time, so good job figuring that out, everyone. So we want to share this with you. If you liked what we put out, we obviously go click through our YouTube page. We're focused on digital entrepreneurs and small business owners, but we obviously love taxes as well. If you have more questions on this, we would love for you to scan that QR code. You can obviously find our emails on our website and all that, but what that QR code does is it gets you to our tax assessment and strategy packages. And we're offering for if you book in the next 10 days, to have a discount off that. And so that will get you a meet and greet with our client success manager, Haley, and you get to, potentially learn if there are other tax advantages. Obviously, in a 30 to 45-minute meeting, we can't go over 940 pages worth of changes to the tax law. But on top of that, besides all the things that you learned tonight from Tonya, we have 200 tax strategies that we do on a typical basis with our clients. So if there is something you're looking to learn from us and work with us directly, including filing your return and strategizing to save your money and help you keep more of it, then go ahead and scan that QR code. Or if that doesn't work for you, you'll get an email in a couple hours with the link that it takes you to. And you can click through and book a time with Haley. Unfortunately, the reason we wanted to get this out really quickly is because of how much misinformation is out there. There's a lot. And then even prior to this bill being passed, there's a lot of misinformation. If you follow us on Instagram, we see the reels that you send us, that you ask us, is this true? And 9 times out of 10, it's not. So there is just a lot of bad information out there. So we always say, even if you are already working with another CPA or tax preparer or EA, stick with your person, but make sure they're passing along good information. One other thing we like to say is if they're not passing on information, if you're only hearing from someone once a year during tax prep season, then maybe it's time to change. If there are opportunities to keep more of your hard-earned money and let the IRS out of your pocket a little bit, that's what we love to do. So Sarah and Neil, thank you for listening and getting your questions answered. I know Dondi and I know some of our friends and our staff were on here tonight. So this will be on our YouTube channel. It will live live. If y'all have any questions, just reach out. We love helping clarify things for our clients and our friends. Do you have anything else to say, Tonya?
I don't. This has been fun. I enjoy taxes so much, and I've loved digging through the laws. So that's kind of my nerdy side.
All right. I see your message, Dondi. You're welcome. We're excited to help y'all out. So we're going to say good night and good luck, and we're going to go eat some dinner. Thank y'all so much.
Thank you,
Talk to you.
everyone.
Bye.